Hi everyone, welcome to the Real Estate Tax Tips YouTube channel. My name is Cherry Chen, a chartered professional accountant located in Ontario, Canada. My mission is to become the Google map for hardworking Canadians seeking financial freedom. One of the things to do to get to financial freedom is to make sure that you stay on the right side of CRA. And over the last few months, I've been hearing a lot of real estate investors being audited by CRA hard. And whenever you go over audits, it's always a lot of paperwork, a lot of time and headache and heartache to go through such a long process. And today, we're going to dive deep into what has CRA done and why real estate investors are the target audience for CRA audit. And we'll also dive deep into the area that CRA are focusing in terms of auditing real estate investor. Every week, I send out an email about money saving tips and real estate tax tips, all designed to help you build your long-term wealth and live life on your terms. The email takes 5 minutes to read and over 10,000 Canadians get it. Think you'll like it. Sign up using the link below. The reality is that CRA has been focusing on auditing real estate activities since 2015. Why did they choose real estate investors as the area of focus? According to the 2010-2011 CRA report, in that year, CRA conducted a bunch of audits, just like any other years. In that particular year, they did a bunch of random audits that helped them to detect significant non-compliance in only 12.2% of the audit. So essentially, they audit 100 people, only 12 people really got audited with non-compliance. That means their return on their audit effort is only 10% or 12% in this case. And they also conducted a bunch of targeted audits in the same year based on the risk assessment detected. So they did a bunch of risk assessment analysis and they decided that there is a bunch of people that they think that would be high risk in terms of non-compliance. So they went about to audit these people, and through these audits, they detected 46.7% of non-compliance. Basically, for every 100 audits that they do, there is about 47 people that have shown significant non-compliance. So therefore, CRA concluded that targeted auditing based on risk assessment has been a lot more effective compared to a random audit. And it has then become the CRA's preferred approach for auditing. And as a result, CRA is making more money doing fewer number of audits based on the risk assessment that they did to identify the high risk area of non-compliance. It's not surprising that CRA has concluded that real estate industry alone is one of the highest area of non-compliance, and that's the reason why CRA has been focusing on auditing real estate investor and real estate transaction since 2015. As a matter of fact, CRA has published a page, a dedicated website to identify the key areas of compliance risk in the real estate sector. And if you visit CRA's website and do a Google search CRA and real estate industry, and you would be able to find this particular page. Now, the key area of concern CRA has identified includes reported income does not support lifestyle. So if you report very low income, but you are living a lavish lifestyle, including driving a $100,000 car, having multiple mansions, and that is one of the areas that CRA is focusing on. Property flipping is the second area CRA is looking at as well. Unreported capital gains on sale of property, especially when you claim that the property is your primary residence. Unreported capital gains on property sold by non-resident. That is also an area of concern. Unreported worldwide income, that's always the case. Because we're all Canadians, we're taxed on all worldwide income that we earn. Whether you earn it in Hong Kong, in Dubai, or in Canada, you are supposed to report it, even though the money may be earned in somewhere in the other side of the world. Unreported GST, HST on the sale of new or substantially renovated home. And lastly, rebates on new homes that you purchased. Now, CRA has done a bunch of audits over the last 6 years, from April 2015 to March 2021, and they were able to recover $584 million on GST and HST new housing rebate alone. That number, 584 million, it's only in Ontario, and they've conducted 41,000, just under 41,000 cases on HST housing and new residential rental rebate. And we're going into in depth in terms of how we can prevent it and make sure that you have the tools to equip you to get ahead of CRA's audit. Secondly, they also recover about 267 million of GST and HST, and they also recover about $100 million of income tax from Ontario alone. There's also a bunch of audit being conducted in BC in particular as well. So these are two areas of focus. Now let's start with the biggest area of focus in Ontario, the new housing rebate and new residential rental housing rebate. There are two types of new housing rebate. If you purchase a property from a brand new builder, the builder charges HST. You just don't know that the builder charges it. So let's say the builder sale price is $500,000. They add in 13% of HST, which is about $65,000. 13% on $500,000 is $65,000. And then typically, builder assume that the buyer is going to move into the property. And as a result of buyer moving into the property, the buyer can then assign the builder the right to claim the HST new housing rebate on behalf of the buyer. Typically, they make that assumption, and in this particular case, the $24,000 is the HST new housing rebate on the $500,000 property. So the net sale price posted on all the billboard when you purchase the property is $541,000. It's actually a combination of the sale price plus the HST subtract the HST new housing rebate. That $24,000. This is the number you see on the ad. But then the people don't understand, especially real estate investors, do not understand that HST new housing rebate on its own is only allowed if the purchaser of the property is moving into the property themselves and using it as their primary residence. And if the purchasers are not using it as their primary residence, and if the purchaser's intention is to flip the property, or if the purchaser's intention is to rent it out for a long-term lease, the purchaser is not qualified to claim the HST new housing rebate, and therefore it is not qualified. You are not qualified to assign the rebate to the builder to claim it on behalf of you. And builder's calculation is assuming that you're moving in, assuming that they're getting $24,000 on behalf of you. So you are all of a sudden not eligible to claim it. And if you are moving in, instead of paying $541,000 in my example, net of the $24,000 rebate, you need to reimburse the builder at the time of closing the additional $24,000. Because you don't have the right to claim the HST new housing rebate, therefore you would not be able to claim it, assign it to the builder to claim it on behalf of you. If you're using it as a long-term rental, after you reimburse, pay the extra $24,000 at the time of closing to the builder, you now have a purchase price of $565 instead of the $541,000. So at the time you sign the long-term lease, 1-year lease, you can submit using a different form to the government together with your long-term lease and closing document. You can submit the claim for $24,000 under the new residential rental property rebate program. So it's two different names. I know it's very confusing. But by doing that, you are all of a sudden legally claiming $24,000. The problem is that a lot of investors are not aware of this particular tax trap. They sign all the paperwork. They didn't even know that they are signing the paperwork to claim that they are moving into the property. And if you are one of these investors, CRA is here to crack that situation transaction down. If you're one of the real estate investors who assigned the HST rebate to the builder, but you rent out the property, you may wonder how would CRA catch you? Well, a lot of you would know land registry is a public record. So when you close the property, your name is going on land registry, and builder provides CRA with a list of units that they claim the new HST new housing rebate on. And upon closing, CRA can obtain the list of owners of these units from land registry. CRA can do two address search. One is to search the address and compare to your name, your own address to the owner land registry title. And if there is any discrepancy between the two, immediately they know there's something's going on. Or CRA can go back to these lists of address and search in their database, and they may notice that some other people, the tenants, namely the tenants, they change their address to these particular newly purchased properties. And that would be how CRA would discover there's a potential non-compliance with HST rebate application. Now that you're aware of how CRA perform their audit, how do you fix it? One of the items that you can do is to come clean yourself. You could apply to CRA under the new residential rental rebate program, submit the documents, submit all the relevant lease as well, and submit to CRA saying that, hey, like I made a mistake. It was really intended for rental. I don't know what happened, and here is the correct application form to get the money back, to get the HST rebate that you already got as part of paying the lower purchase price, and assign that rebate to your new residential rental rebate application. You are going to be able to come clean that way. The only catch is that make sure that you do it within 2 years after closing, because the new residential rental rebate program is only has an expiry date, and the expiry date is 2 years after closing of the newly purchased property. Now, the second part of the audit that CRA had done is related to the income tax program and GST and HST that they've recovered in particular in Ontario and in BC, and like I mentioned before, they recover over 270 million and about $100 million of income tax. So all these numbers add up. How did they recover so much money from income tax and from the GST and HST perspective? One of the reasons is the property flipping part. They are specifically targeting professional contractors and renovators that rapidly buy and sell real estate at a profit, sometimes demolishing or renovating the property. They are also targeting speculators or middle investors that buy property before its construction is completed and then assign the right to sell clause that is in contract to another speculator or the final buyer. They call these shadow flipping. Essentially, I call it wholesaling. It can occur many times between the first sale and the final sale of a property. And then there are individual renovators that they buy real estate, renovate it, and live in it for a short time period before selling it for a profit and claiming the capital gain as principal residence exemption, so they don't pay tax on it. Now, I mentioned before in the past, a lot of people are under this misconception that all property sale is capital gain. Well, the truth is that not all property sale is capital gain. The reason why we want it to be called capital gain is because capital gain is only 50% taxable and income is 100% taxable. And that's the reason why it's a deliberate shift to claim all property transaction as capital gain because of the potential tax saving available. But the truth is that you cannot just call a property sale as capital gain as often as you want. It is really decided based purely on a bunch of criteria I'm going to talk about. First criteria is taxpayer's intention. What's your intention? Are you planning to buy it as long-term investment, or are you buying it just to flip it? If it's a flip, it's business transaction, so it's the profit you made from it is considered income, not capital gain. Second criteria, how likely are you going to be able to carry out all your intention? If you say that, oh, I'm going to hold it long term, meanwhile, you actually have no cash flow or you have no financial resources to qualify for financing for a particular property, it's impossible for you to hold it long term instead of doing a quick flip before closing. So these are the criteria that CRA looked at. Geographical location and zone use of the property. CRA also look at that. Extent of the intention that you would be able to carry out. You claim that you want to rent it out. How much work have you done to qualify for financing? That is something that CRA is going to look at. Evidence that the taxpayer's intention changed after you purchase the real estate, CRA also look at that. Nature of your business or what you do for a living. If you are a full-time employee and you are working as a bank teller, it's less likely that your transaction, the sale of your property, would be called on the income account, would be considered income. Extent to which borrowed money was used. If you use a lot of finance money, if you borrow against your own home to purchase your rental property and then you flip it for a quick profit, then it's more likely, this transaction, it's more likely to be considered on the income side rather than capital side. And the profit from it would then be 100% taxable instead of 50% taxable. The length of your ownership, if you own the property for a short period of time, it is more likely to be considered on the transaction. The profit would be more likely to be considered on the income account over capital gain account. Existence of other partners, if you partner up with an investor who's a specialized investor who has his own real estate agent license, also has a team of contractor, chances are the transaction is more likely to be considered on the income account instead of capital gain account. Nature of the occupation of the other person, your partner, what do they do for a living? Factors that motivate the sale of the property and evidence that the taxpayer or your joint venture partner had dealt with extensively in real estate. So these are all the factors together, not one over another, is everything together that I mentioned that CRA look at and would analyze your transaction to determine whether the transaction, the profit made, is considered to be on the capital gain side or income side. So when we talk about property flipping, generally, they are considered on the business income side. If you want to be able to argue that the property flipping is on the capital gain side, you have to look at all these criteria to document your story and your reason why your transaction would be considered on capital gain side instead of income side. So then you would be able to pay less tax. But CRA is going after the incorrect classification of property flipping on capital gain versus income. Like I mentioned before, example of income includes assignment deals, flips, land development, wholesale service, rent to own, 100% taxable, and you could trigger HST implication as well. If you own these properties and made sale of these properties inside a corporation, the sale of these properties would be taxed at 12.2%, assuming it is 100% taxable. If you own them in your personal name, the profit is subject to a marginal tax rate as high as 53.5% in Ontario. Now, example of capital gain is essentially anything long-term buy and hold with rental income. It could be commercial plazas, multi-residential units, single-family home condos, industrial buildings, vacant land, strip malls, office, even Airbnb. They are all considered long-term buy and hold. If you hold it long-term with the intention to really generate rental income, those would be your example of capital gain transactions. Now, CRA mentioned that they are also targeting speculators or middle investors, which are mostly wholesaler and pre-construction assignment deals. And wholesaling is considered a business, 100% taxable, and there is also HST implication on the wholesaling fees. Profit is 100% taxable. In terms of pre-construction assignment, there is also HST implication as well. Right now, CRA has issued a policy that they would also take the deposit that you get from property assignment. Typically, when you sell a property on assignment, you enter into agreement with the builder, and before closing, you would then sell it to assign the right to purchase a property at a higher profit to someone else. And during this process, you will also collect the initial down payment deposit that you have paid to the builder. And CRA has issued a policy essentially saying that they are going to also consider the supply of that deposit, the reimbursement of your deposit, subject to HST. They are also considering that deposit as a commercial activity and it is subject to HST. Although there are court cases that are going against that, but CRA is taking a very aggressive stand on it. And the profit that you made from assignment are generally considered income, 100% taxable. The next scenario and most audited situation, which has been around forever, is when some people build their own home, build at home, and essentially move into the property and then sell it within a year. And they claim that as their primary residence. But this is a myth. Just because you move into the property for a period of time, it does not necessarily mean that you can claim that property as your primary residence. It all goes back to the transaction itself, and CRA look at if the transaction is on the capital gain account or income account. So if you are moving into the property and you are a contractor, you just build that property yourself and you essentially sell the property immediately after you move in, within a short period of time, and you do that all the time, CRA would come back and really analyze your transaction based on the capital gain versus income criteria that I mentioned. So your intention, how likely you're going to carry out the intention, your location, your professional knowledge, how often you do these deals, and all these criteria that I mentioned earlier, and they would then make the conclusion to decide whether the transaction is on the capital gain side or income side. If it is on the income side, you would not be able to claim primary residence exemption, even though you move into the property. Now that we cover the HST rebate application, how CRA recover their income tax from taxpayer, we are going to how CRA recover HST and GST from real estate investors. It is all coming from the HST implication on substantial renovation, on flips, and new homes for sale and for rental. If you are purchasing a property or if you are substantially renovating a property, you may be liable for HST on the fair market value of the property. And we did a different video specifically talking about that. And you can refer to that video above to get a better understanding and detailed illustration on what substantial renovation means. Essentially, substantially renovating a property means that a property is all or substantially all of the existing building is removed or replaced. It means 90% or more of the existing building is removed or replaced. If you gutted a house from top to bottom, there is a chance that you may be required to charge HST on sale of a residential resale property, which is generally HST exempt. Now, another scenario that may trigger HST implication is when you build a new residential rental home. You're considered a builder, you need to pay HST when you build something brand new, purpose-built residential home. You need to pay HST on fair market value of the rental when it is ready to move in. You can offset the HST payable by claiming the HST that you pay to the builder or you pay to the contractor to build the new rental, and only the net HST amount is payable to CRA. You can also qualify for HST new residential rental rebate, which we mentioned earlier. Now, if you're building a new house to flip, you are also considered a builder. You need to charge HST on fair market value at sale, just like a builder. You can also claim HST residential property rebate, just like a builder. You can offset the HST payable by claiming the HST you pay to bill. Only the net HST amount is payable to the CRA. And these are the factors that they would look into, the area that CRA has looked into to recover millions of dollars from HST and GST in the real estate sector. Now that we have covered all the criteria and the area that CRA has looked into, here are some other audit triggers that I found over the years you may also want to avoid because it may trigger a CRA audit. One is large amounts of rental losses that you are reporting in consecutive years. You may sell multiple properties that you own within 1 year or back to back in multiple years. Back to back, you sell 1 year after another after another. You assign HST residential rental rebate without moving into the property. That's also an area of audit. Ask for HST refund when your input tax credit, when the HST that you pay is greater than HST you collected. You're not reporting any capital gain on sale of property at all. That could also be a trigger. You reported income, the reported income does not support the lifestyle or asset that you own. These are all audit triggers that CRA are looking into, and you may want to try to avoid having any of these and have a good discussion with your own accountant or with our team to avoid any of these audit triggers. Now that we have covered a lot in terms of the CRA tips and tricks with the audit in the real estate sector, if you find this video useful, make sure you give us a thumbs up. If you have any questions, make sure that you leave the message in the message comment section below, and I'll get back to you. Until next time.